Efficient markets hypothesis is the discussion of the day, and this is Jessica Dunn. So first up, let's talk about why stock prices are so volatile. Stock prices, when we're determining the intrinsic value, that intrinsic value is dependent upon several different inputs, and those inputs can change. So let's look at the Gordon model here, for example. It says that the value today is equal to the next dividend received divided by the required return minus the growth rate. So there, our growth rate could change. News could come out that would allow us to believe that dividends could grow at a faster rate than previously predicted. Our required return could change. So the demand that we have for return given a level of risk could change. So that could mean that the market risk premium is increasing. The risk-free rate has increased. So inflation expectations, risk aversion, company risk. And together, that can cause drastic changes in stock prices. So here, let's see what small changes in required returns and growth rates produce. So here's an example. Now this is, the background doesn't matter so much to the example. We're just looking at how changes in growth rates and required returns change the stock price. And so here we see that this stock, when it has as the growth rate increases, the stock price increases. We also see that as the required return increases, the stock price decreases. So our requirement for return given a level of risk increases, then then our stock price is going to decline. So here let's look and see what happens. We have, if the growth rate is 4% and the required return was 10%, then the stock price is $33.33. Now let's see what happens if our growth rate is 6%, so it's gone up 2%, and our required return decreases to 9%. Our stock price changes to 66.67, so a 2 percentage point difference in growth rate and 1 percentage difference in required return causes our stock price to double. And new information is coming to markets continually, and so these expectations are continually fluctuating, which causes volatility in stock prices. If stock prices weren't volatile, then that would mean that there isn't a good flow of information. So at equilibrium, the intrinsic value must equal the actual stock price. If the market price is different than the intrinsic value, then that is going to cause either an increase in demand or a decrease in demand, which will cause prices to change. So if the actual stock price is lower than the intrinsic value, then investors are going to want that stock because it's underpriced. And so demand will increase and the stock price will increase because of the increased demand. And the opposite is true as well. So in equilibrium, the intrinsic value must equal the actual price. So that means that the expected return, which we said was dividend yield plus capital gains yield, must equal the required return. So we must be getting what we require. Our expected return and our required return must equate. Remember, our required return is calculated using the security market line. It's the risk-free rate plus the market risk premium times beta. So if the expected return, that dividend yield plus the growth plus the capital gains yield, is greater than the required return, then the current price is too low. If the price is lower than the intrinsic value, then that stock is a bargain. Investors will demand more stock, and because demand increases, price will also increase. And it will increase until the expected return is equal to the required return. So what is the efficient markets hypothesis? The efficient market hypothesis says that securities are normally in equilibrium and that they are fairly priced. that it's difficult to beat the market for any reason other than good luck or inside information. It does not assume that investors are rational, but it does assume that stock market prices are a fair representation of intrinsic values. If stock prices deviate from the intrinsic value, then investors are going to take advantage of this mispricing. Prices will be driven to new equilibriums based on the information that's available, and it is possible to have irrational investors. There are different forms of efficient markets hypothesis. Weak form efficient markets hypothesis says that you cannot profit by looking at past trends. Just because we've seen stocks go up in recent days, that doesn't mean that they're going to continue to go up. There is evidence that supports the weak form efficient markets hypothesis, but still investors use recent movements to predict future movements, and this is called technical analysis. If the weak form were true, information about recent trends in stock prices would be of no use in selecting stocks. The fact that a stock's price has risen over the past 3 days would give us no clues as to what would happen today. If there were a reliable pattern, other investors would catch on and it would disappear. Semi-strong form efficient markets hypothesis says that all publicly available information is already reflected into stock prices. So it's of no use to watch the news, read the newspaper, look at annual reports, and try to find undervalued stocks. And this is largely true. When you look at these big investment companies, they often have hundreds of thousands of highly educated individuals and very sophisticated algorithms looking for new information and looking for mispriced securities. So for the average person, it doesn't really pay that much to read annual reports and watch the news and read the newspaper. Strong form efficient markets hypothesis says that all information that exists, including insider information, is already incorporated into stock prices. This is not true at all, and because if it were true, then we wouldn't have insider trading laws. We know that insiders can gain by trading on the basis of insider information. Most studies suggest that the stock market is highly efficient in the weak form and reasonably efficient in the semi-strong form. The problem with the tests, though, are that they use joint testing. They test whether a particular strategy can beat the market. So they're looking at strategies and they're trying to guesstimate the market returns, and there's not even a really great measure of market returns. So there's not, if there is a strategy that can beat the market, it has not yet been tested. So strong form efficient markets hypothesis does not hold. For most stocks, most of the time, it's safe to assume the market is reasonably efficient. However, there can be major shifts causing stocks to move strongly up and down when we look at the housing crisis, for example. Investors have, to a large extent, given up trying to beat the market, and that does help explain the popularity of index funds and mutual funds, where they're able to just purchase a basket of stocks that provide them with adequate diversification. So there are some important implications for stock issues. If the market prices stocks fairly, then managerial decisions based on over and undervaluation might not make sense. And managers do have better information than the public, but they cannot use that to their own advantage and cannot deliberately defraud investors. Stock market bubbles of 2000 and 2008, they suggest that something other than pure rationality in investing is alive and well. We do know that behavioral finance has large implications in the field of investments. We know that people anchor too closely to recent events when predicting future events. So if the market is doing really well, they tend to think that that's going to continue. Other investors will emulate them and follow like a herd of sheep, which is a proven behavioral finance phenomenon. Markets are rational to a large extent, but they are also subject to irrational behavior. You do need to use careful, methodical analysis when making investment decisions and recognize that actual prices can and do differ from intrinsic values, sometimes by large amounts and for long periods of times. But the nice thing about that is that it provides good news. Whenever we see differences between true value and actual prices, then the astute investor could capitalize on that mispricing.